Hey, Rob, good to see you. Ever since we launched, we've been getting all these questions from everybody about, well, how do I make sure that I'm protected in retirement? How do I make sure that I have income? How do I make sure that, that everything doesn't go up in smoke? And so I thought this was like a good opportunity for you and I. This is Rob Hordon, by the way. I'm Trish Regan. You and I to kind of talk about all this, given that people are obviously understandably cautious. You want to make sure that you've got something there in your nest egg. It's one of the reasons why we created the income builder portfolio. But, dividends, Rob, they matter, and they can matter a lot, especially later in life when you don't have that job that's providing you with the weekly paycheck.
Yeah, that's right, Trish. Dividend income is a really interesting thing to focus on, I think, from the standpoint of planning for long-term financial planning for retirement. It's a topic near and dear to my heart. I love getting a dividend deposited into my brokerage account. It's like getting a paycheck without having to go to work, right? Kind of the American dream. But
Beauty of investing, by the way.
uh, I've been personally focusing actually on dividend stocks and dividend investing since about 2011, when at one of my old firms helped lead the development of what we call the income builder strategy. And this was around 2011. It was in the context of a low interest rate environment. Treasury yields had gone down close to 2%. And people were looking for income solutions, and they weren't really getting that from the bond market. So the idea was develop a strategy that really kind of leaned into equity income opportunities that would provide that long-term income generation that, particularly as the baby boomers were approaching retirement, and that's where we are right now, fast forward 10, 15 years later, looking to the equity markets to provide the income solution.
Yeah. And just jargon clarification for everyone. And most people know this, but equity markets being the stock markets and, bond markets being fixed income. I'll give you a quick little aside. When I first started at Goldman Sachs, it was my first real job, and I was assigned to the fixed income department. And I remember we were trading, sovereign debt, bonds in emerging market countries. And I called my parents, Rob, and I said, "What is fixed income? Am I supposed to be helping retirees or something?" I had no idea where they were even putting me. So it just gives you some perspective on, that was a lot of years ago, back in 1999. But I too like dividends a lot. And that even goes back to sort of my childhood, when I can remember my parents when they first started investing, and you're going back to like the late 70s there, and they started putting money into dividend stocks, which, by the way, they've kept this portfolio forever. I mean, this is a big part of what sustains them now. And my father's attitude was, hey, you know what? If the stock's going down, at least I'm getting paid for it, which I always thought was funny and kind of clever, and actually incredibly important when you think about the longevity, right, of investing and how one day you actually do want to be able to live off of that. In his case, he was often reinvesting that money. My parents would reinvest. So that was like a dividend reinvestment plan they were on. All that said, it's a little more complicated than it looks, which is partly why you and I are doing this here today, because it's really easy to get distracted by things like yields, right? And you can say, this dividend yield is fantastic, and I'm going to buy this because of the dividend yield. But I think people need to be thoughtful, do they not, about how that yield compares and contrasts with the rest of the company itself.
Yeah, absolutely. I mean, after years of dividend investing, I think there are a lot of pitfalls, and we'll get into that. But maybe we can really kind of start framing the discussion. You mentioned fixed income, and the thing about fixed income is that it's fixed, right? It's level. It doesn't grow. If there's inflation, it stays flat. So it could be helpful to take a look at the difference between an equity income approach, a dividend income approach, and a fixed income approach.
Well, and we've got some charts on that we wanted to share with the listeners and the viewers. You're right. I mean, because fixed income can be pretty attractive, and there's a place for it, by the way. Yep. But simultaneously, sometimes over the long haul, what you're going to find is a better return in the equity market. Here we're looking at high dividend stocks versus the total bond index. And this is basically if you were to invest, say, $10,000 10 years ago, what you'd be looking at. Walk us through it, Rob.
Yeah, so this is actually looking at the income generation of a $10,000 investment. If you're looking at two different options here, one is to buy an ETF called VYM, which I chose just because it's basically a proxy for the high dividend portion of the stock market. And then the other one is BND, which is an ETF that's a proxy for the total bond market. So it's really kind of comparing the total portfolio of high dividend stocks versus the whole total universe of bonds. And you can see if you went back to put $10,000 into it in 2014, out of the gate, you actually had a bit of a higher yield from the stock portfolio. But over time, it really, because of the growth in the dividend stock index, it really, ended up more than doubling the bond investment. And really, this completely understates the point. Going back to the point you made earlier, where you do have the opportunity to reinvest dividends and kind of compound that income growth. So that's just looking at the $10,000 receiving all those dividends as cash flows and not reinvesting.
There's another chart here which kind of I
Yep.
think articulates it well. If you look at, say, high dividend stocks versus the total bond index, right? This is the Vanguard total bond index versus that high dividend yield index ETF. And again, it's well, actually, this is a pretty drastic story, I think, when you look at these two charts.
Right, and this one captures that reinvestment of dividends. So we're looking here at total return, and you can see if you bought that high dividend yield ETF 10 years ago, your total return. This is all indexed to 100, so your total return was more than 150% over that 10-year period. Whereas with the bond ETF, it was less than 20%. So really, as I was looking at this chart, I was thinking, what's the right analogy? Is this the tortoise and the hare? But really, that's not even right, except for because eventually the tortoise is supposed to catch up with the hare, and maybe the two lines intersected briefly during the pandemic. But the reality is, it's more like a car versus a bicycle. You almost feel bad for the bond investors, and when looking back at this graph, the amount of money,
Sure.
the opportunity
No, I
cost.
mean, but some people, and not to completely poo-poo bonds, because I think that, it's important to have a diversified strategy, but and often there's a tax advantage to bonds, especially if you're in a certain category of wealth and income. When you look at munis, for example, and so you got to factor all that in. But that dividend benefit, I think, and the ability to compound that actually can be pretty incredible. And then you think about, again, going back to this chart, the bicycle and the car. Really, I mean, this, and this probably, in fairness, is not even indicative of the entire equity market overall, because stocks in general have just been on such a tear. And there's a lot of reasons for that. But I guess the bottom line is you want to be invested in the stuff that's really going to be long-term able to service you in your retirement.
Yes, if you have a long time horizon, the outperformance, the higher return that the stock market can offer you, it really hits home when you look at it, how these numbers compound and play out over a longer period of time. And here we're not talking about 50 years; we're talking about 10 years of very significant outperformance.
I think that's an important thing to remember. I mean, if you have 10 years and look, you can't time the market, and that's not what we're about at 76. I mean, if you think about us and what we're trying to do, it's really to help people invest for the long haul, so that one day when they do want to retire, they're going to have that opportunity and they're going to have that income. There's another chart, it's a little complicated, but let's throw this up here anyway, because this is explaining the 10-year Treasury yields versus credit spreads over the last 10 years. You want to take a stab at this one?
Yeah, sure. We'll start with the top. It's the 10-year Treasury, and really, this we can pivot a little bit into a discussion over bonds. I think we've had a lot of interest. What do you think of the bond market now? The argument I would make at the moment as we sit, we're at a point now where the 10-year Treasury yield is about 4.25. And you can see in the top chart, it's sort of towards the high end of where it's lived over the last 10 years. One of the interesting things, and maybe the most interesting thing about buying government bonds, buying something like the 10-year Treasury, is that it is usually, not always, usually what we call, negatively correlated with the stock market, meaning, when the stock market zigs, treasuries zag. So you see the real kind of two major episodes: the global financial crisis, obviously the stock market crashed, treasury bonds rallied in that situation. So the yields came down, meaning the bonds went up in value. And during the pandemic as well, the market crashed, bonds went up in value.
Sure.
Yeah. Now,
Sure.
a big exception to this was 2022. That's a scenario where the Fed started tightening, interest rates went up, we had inflation, both stocks and bonds did poorly, government bonds. Yep.
I said at the top, it's tricky trying to know what to invest in for dividend stocks. And one of the challenges too is that, if you go to your portfolio advisor, your money manager, whatever, you say, hey, I want a dividend portfolio. What do you got? Oftentimes I found, it's been my experience that they'll present you with some variation on the S&P, right? Like, so you get Apple in there and you get all these tech stocks and you're like, well, wait a second. I kind of wanted those dividend plays. I wanted, some good old energy companies and those kind of things, kind of the boring guys, right? That will be there for me and not be subject to the same kind of volatility. Now, granted, they may not be getting the same kind of upside as a tech stock that happens to have a dividend that they're sure to put in there in a lot of portfolios. But one of the things that I like, and one of the things that you and I talked about when we came up with the income builder, was we wanted to have strategies for those companies that would provide you with that income and a little less sort of volatility, right, over the years. You can't predict what's going to happen, but at least, having those steady dividend plays is important. And then it's a very big universe. Like, where do you start? How do you know what to pick?
Yeah, you're right. It's a big universe, but it's also a universe that has shrunk in the sense that I think the dividend yield now on the S&P 500 is about 1.3%. And really the whole complexion of the stock market has changed towards growth, particularly with all of that outperformance that we've seen over the last 10 years and very recently with growth stocks. So even if you take now the high dividend portion of the total stock market, it's still actually not that high yielding, right? Because it's just the stock market itself is so low yielding. So I think when you're thinking about dividends, it becomes more of an exercise in identifying individual dividend stocks, picking stocks, security selection. And that's what we're really trying to do with the income builder portfolio, where we have, typically 10 to 15 hand-picked higher yielding stocks that we think are good in and of themselves. We're not just owning them because they have a high yield. We're considering them because of their yield. And the average yield on the portfolio is about 4 to 4.5% right now. Again, comparing to like the S&P 500 yield of 1.3%, so much higher yield. So we're considering them because of their yield, but we're really choosing them because we think they're going to be good
companies,
long-term total
good
return
solid companies.
Yeah,
and we have gotten a lot of questions, specifically emails and commentary on YouTube, et cetera. But we've gotten a lot of questions about making sure, as we started this conversation, that you have something there and that you're not overextended in terms of the volatility, et cetera, as you get into retirement. And so it comes down to, okay, well, like, how do you pick these? And, there's a strategy involved, as you pointed out. You want to make sure that you have good companies. And I think there's one chart I can show folks of, a couple of stocks that are dividend plays, and yet one is significantly better than the other. And that's important to keep in mind, because not all dividend stocks are created equal. Here we're looking at Annaly ticker symbol NLY versus Digital Realty, DLR. I'm laughing about digital realty because it's actually in my parents' dividend portfolio as well. I'm kind of laughing about it, but anyway, let's go through this because this is again like the bike and the car. I mean, one has completely taken off, and one is basically just kind of sat there.
Yeah. So digital
Like a
realty, it's
car with a
actually,
bad engine.
these are both real estate investment trusts. It's kind of a tale of two REITs here. Digital realty is a recommended position in the income builder portfolio. It's a data center REIT. I draw the contrast here because I mentioned going back running income funds going back more than 10 years. Annaly was always a stock that people kind of asked about, and a lot of income fund managers would want to uh, have in their portfolios because it typically offers like a double digit yield, right? So a very high yield, and it's sort of the kind of stock that an income fund manager might not want in their top 10, but they kind of want it on page 2 because it sort of gooses the yield of the fund. But that really kind of hits to like what the real risk is when you're investing in dividend stocks. We walk through on the website at 76 Research. We put a piece together that's called Investing for Dividends, and there we highlight what we think are the five big risks or mistakes that people make as they try to create a dividend strategy and build a dividend portfolio. So, the first one I would say, and this is the most important one, don't confuse dividends with profits. Dividend yield, it's not really a value signal, right? And the analogy I would draw there is, let's say you were trying to make some sort of guess about how much money someone makes based on the car they drive. Yeah, maybe there's kind of a correlation, but I drive a 9-year-old car. I think you said you drive a 12-year-old car.
I do. I have one that's like, it's maybe even older than that because I bought it used and I've had it for some 12 years. I have a nicer new one too, but I'm a big believer in driving the cars until you can't drive them anymore.
Yeah. So
and it has no relevance. You're right on sort of overall.
It's like the dividend yield shows how much money the company is releasing or spending, giving back to the shareholders, not really how much it's generating. So it's kind of correlated with earnings and value and profitability, but it's not a measure of it. So I would say the first point is don't make that mistake in conflating the two concepts. And second, like a related point, and the Annaly versus digital realty chart kind of brings this one home. Don't overreach for yield. Annaly is a name where you can get like a double digit yield and it's very attractive on the surface, but over time, it's not necessarily going to work out for you. Really and this actually kind of brings to a third point about dividend investing. The way Annaly kind of generates that high yield is through leverage. They basically buy mortgages and use lower cost debt to kind of create this like amplified income return. And it's basically an exercise in financial engineering that's riskier. And that's sort of why you've seen some of that volatility in Annaly over time, especially with interest rates going up. That's been harmful for their business. Whereas, when you invest in an income stream that's more based on fundamentals, more based on real growth in an underlying business, you have more opportunity for kind of longer term continuous compounding.
Yeah, and that's the idea. I mean, there's a lot of names in our income builder portfolio, and I want to just really stress that people can go and
Yep.
go and get that. Go to 76 Research. We actually have a promotion going on through the end of the month. So DIVS 76, think dividends, right? DIVS 76, DIVS 76, and you can get a discount. What is the discount?
It's 20%.
20%. So that's significant off of that model portfolio. And what we do is we've got these stocks between 10 and 15 in each of these model portfolios. This income builder, I think, is just so important for people. Again, going back to when you and I started this, it was such a priority for me because look, I mean, even in my own life, right? I mean, at some point, we're not going to do all this forever. I mean, maybe I will just because I'm wired that way. But at some point, you just want to be able to sit back. And as you said, it's kind of nice when you get a check and you didn't actually have to go to work for that. So I think that that's a common goal. It's very much the American dream. And everybody that's watching this now wants to be able to say, hey, wouldn't it be nice to just be able to live off of my investments? And so you want to be able to do that without taking on enormous amounts of risk. And so for me anyway, and I know for you, given your background and given where you've worked and how you've managed money over the years, having this income builder portfolio is very much part of that. So I want to encourage people, go to 76research.com, look at the model portfolios, look at the income builder, DIVS, DIVS 76. And hey, like this is, I'm so proud. I'm so happy to be doing this because I really think that people need to start focusing on themselves and their future and doing so in a conservative way that's going to give them the most runway and opportunity to have a prosperous existence later in life.
Yeah, absolutely. And if you set up a nice dividend based portfolio for yourself, you don't have to invade the principal. It's a very nice setup, I think, for a private investor as they near or enter or even in retirement.
Sure thing. Hey, Rob, good to see you.
Great to see you.
We'll talk soon. Bye-bye.
Okay. Bye-bye.